Okay, welcome to this course again officially now. And let's start with chapter 1. The course is 621, Accounting for Managers. The objective is at the end of this course you to have enough knowledge about financial statements and management accounting so you can make intelligent management decisions. First chapter is overview of financial statements and why do we need the financial statements. Those are the learning objectives that we try to achieve through this chapter. So now what's the financial accounting? Every time when people say finances, you're thinking only about money, 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 money. Pretty much you're correct. Now, but what is exactly is the financial accounting? This is a process which is done by still humans, which capturing, analyzing, and reporting the event that happen in the company or in reality, which are presented as a transaction, and then it translated to the financial statements, which financial statements are given to the users of the financial statements. Now the question is, which are the users and what they want to see? Because different users, they want to see different things. So once we know the users, then we can figure out what they want to see. There for different purposes, different users. The main users are investors, creditors, management. Why the investors want to see the financial statements? Because they want to invest. Why they want to invest? Because they have money, which doing nothing with those money. They want to make more money. In order to make money, they want to invest. Creditors, same idea. They have money, but they don't want to invest in this case. They just want to lend the money to somebody else in order they to uh, get some fast cash in form of interest. And the last one is the management. Again, there are other users, but those are the three main users. Managers, what's interesting with managers, what they need the reports. They need the reports to make some management decisions inside the company. We're going to see second part of the course, what kind of decisions these people make. Now, the financial reports are prepared for the period of time. The annual reports are the most common one, which showing the what happened in the company during the year or during the financial cycle of the company. Now, let's see what other users we may have and what kind of questions they're asking yourself. We already talked about the management. Management is asking themselves, what can I do? What else I can do? How I performed the last year? What else I can do in change for the next year? Now we coming the other parts. The other part of the users are, as we said before, potential investors and the customers. Those are chasing performance of the company short term, long term, because they want to see how the company performs. And if I invest in this company, I want to make sure that I'm not losing my investment. The other one was the creditors. What the creditors looking? Creditors looking for is this company has ability, if I lend them my money, to give me the money back plus the interest. Again, we said those are the three main category: creditors, investors, and managers. Now we have another. We have employee and union. The employee usually chasing, is this business profitable in terms of if I start working here, can they pay my salary? And I don't want to lose my job in the next 2 to 3 years. So this company is going to stay that long. Auditors, government, they also want to know about the company. Government wants to know about the company because they want to get their taxes. Auditors wants to confirm the financial statements correct because the investor want to make sure that whatever they read on the financial statement is actually audited by the auditors and confirmed by the auditors. Then we have another group of the people which only using the financial statements to make some prediction. Those are the stock analysts, brokers, financial advisors. They're looking for uh, financial ratios and try to find the trend in the company from statistical point of view. Basically, they're doing analysis of financial statements and they're expressing their opinion based on those analyses. Stock exchange regulators, those are for the public companies which are traded on the stock exchange. And those stock exchange make sure that the financial statements of the company, which are traded on that particular stock exchange, meet the regulation for that particular stock exchange. Then we have the shareholders and board of directors. Now, the shareholders also can be seen as investors, but they generally they're interested on how the company perform, when I'm going to get the dividend, is the board of director board working in my best interest? Now, in the two main groups that we can divide those users, as you can see, we can have two type of users. Ones which are inside the company and the one that are outside of the company. Internal users are the one inside of the company, those are managers. And then we have this huge amount of the users which are outside of the company or external users, shareholders, board of directors, potential investors, creators, regulators, tax authority, journalists, labor union, credit rating agency, and all the others. Now, how about the shareholders? Well, again, the shareholders are part of the investors. Shareholders already invested in the company, but we have this huge category of the potential investors, which are looking for the financial statement in order to decide should I invest or should I not. Now, the corporations, which people want to invest or want to create in order to run the business, and we have two types of corporation. One is the private company, and the other one is the public company. So we can have additional financial users. Those are the creditors, regulators, tax authorities, and all the others which we sell. Again, those are all outside for the company. Now, since we start talking about the corporation, that's bring the question: what is corporation? Now, the corporation is type of company which is owned by the shareholders, which provide the initial capital in form of cash or other assets. And they have certain certificates that they holding, which is called share certificates or common shares. The interesting thing with the corporation is that this organization separates the owners from the corporation. And we create a separate legal entities. The two main type corporations, one is the public, the other one is the private. What's the difference? The difference is the public company can trade their common shares on the stock exchange, public stock exchange, which every person which is part of the public can buy it. With a private corporation, that's not the case. They're not trading their shares on the public stock exchange, those are traded privately. Now that brings us to the form of business. What kind of form of business we have here in North America? Three type of form of business. One is the proprietorship. The other one is the partnership. The third one is the corporation. What's the difference? What makes them different one to another? Well, we have to take a look at different categories and different aspects in order to find out what's the differences. In the number of the owners only, the proprietorship is owned by one single person. In a partnership, you need two or more. Now, the corporation, it can be single person or can be two or more. Which one creates a separate legal entity? Only the corporation creates a separate legal entity. Both proprietary partnership are not. Then who is liable? Liable is the partner or the owner of the proprietorship. To what extent? To full extent in some cases. What that means? That means for the sole proprietorship. So if you're a sole proprietor, means single owner. If you own money, the people can go after your personal assets. On the partnership, still the same, but there's some legal implication which can limit your legal responsibility to some extent. With the corporation, that's not the case. Shareholders are their liability is limited to the assets that they invested in the company. On the responsibility for the debt of the business, proprietorship, again, owner is personally responsible to the debt of the business. Partnership, partners are personally responsible to the debt of the business. In the corporation, shareholders are personally responsible, but only to the extent of their investment, nothing more. How they paying taxes? Corporation pays taxes itself, separately from the owner, where in the partnership and proprietorship, taxes are paid by the owners or the partners. Which one is the least expensive? Proprietorship. Which one is the most expensive? Corporation. Which one is the middle? Partnership. How how much is gonna cost you to start the corporation now? And how long is gonna take you? 5 days to check for the name of the corporation, and 2 days, actually 24 hours to set it up. So that gives you probably 6 business days. You're done. How much gonna cost you? Around $500 to $700. Also, sole proprietorship, you don't have to do, you can start the business right away. What's the cost to maintain or keep it going? Proprietorship is the less expensive. Corporation is the most expensive. Why? Because they have to have a structure. You have to have director, president, and all the other people that's coming, management. Partnership is the moderate expensive. How about to make the financial information available for the other people? Only and only corporations, and only if they want to have investors or creditors. Proprietorship, partnership, they don't need to make it available. Now let's see, what's the business activity in every business? We have three main business activities. First one is the operating activities. The operating activities, the one that the company generates operating cash. Then we have financing activities, which company getting the resources to operate, and investing activity, that's the resources when the company from the financing activity get the resources to operate, generate cash, which is not needed for the operation. Then for that cash, which is not needed for the operation, the company starts thinking about investing. Financing activities. Let's see what's the financing activity involved. The financing activity, we have two type of sources for the finances. Either person has to invest, either the person has to borrow money. There's no other options here. If you want to create a business, you have only two options. Either you have to find an investor or you to invest. Either you have to find a creator in order to get the cash. If you have investors, you're going to give them shares. If you have a creators, you're going to make him promise that you're going to pay him the money back plus the interest. Those involve two cash activities. Cash inflow by taking the loan and issuing the shares, and two cash outflow activities, which is the if you borrow the money from the creator, you have to pay them obviously principal, and also you have to pay him the interest. And for the investors, you have to pay them dividends. Otherwise, they're not going to invest anymore. Then we bring it to the investing activities, which is the investing activities. Usually, the investing activities company doing with the cash available. In order to start the operation in the very beginning, company has to have assets or long-term assets which can help you to start a business and start operations. Those are called property, plant, and equipment. We're going to see in the next chapter. What are those? Or the company can buy investments or can invest in the other company or lend money to the other companies. What is the cash activity here? Cash inflow is the money that company can get if decide to sell the property, plant, equipment, and if this company decide to sell the shares or get the money back from the people that lend the money. Outflow is to purchase those property, plant, equipment, or to purchase the shares of another company, or give the money to the company who want to lend the money from us. And that brings us to the last activity, which is the operating activity. Operating activity is the essence of the company. Those are related to everyday operation of the company and fall in two main categories of revenue expenses. Cash in the company comes from the sales to the customers, and the cash flow is all the cash that's going out for the business expenses, which helps you to generate the sales or helps you to operate. What are the financial reports? Financial reports, we have 5 financial reports. Always starts with the statement of income. Then is the statement of changes of owner's equity. Then we go into the statement of financial position, statement of cash flows, and notes to financial statements. Since we start with the first one, let's finish those statements and we can finish today. First one is statement of income. This is the most, I won't say the most important, but one of the important. All the 5 are important. Let's not emphasize which is important, which is not important. Let's put it, all of them are important. Statement, but what we can see on the statement of income, on statement of income, we can see how much sales this company generates, what other sources of income has, and which are the main resources from where the company using to generate those sales. That will be our expenses. So everything during the period of the company is going to be structured to revenue minus expenses. Once we get revenue minus expenses, that's going to give us net income or profit. As long as the revenue is more than expenses, we can generate profit or net income. If the expenses start getting more than the revenue, the company is going to generate loss or net loss. But the statement of changes of equity is going to tell us how the owner's interest has changed based on what's happened in the company during the period of the changes. There are two main components here: share capital, or how much owners invest or keep investing, and what's the retained earnings. Now, we're going to see later that retained earnings is the net income that the company keep inside the company. And that goes directly to increase the shareholders' capital. Or we're going to change the equity. Next one is the financial position. That's going to tell you where the money of the company are. Everybody wants to know, is this company generate income? Yes, it does. How much is left for the owners? That much. Where is it? And you start telling them. Half of them is in the bank in form of cash. The other half is in the inventory in form of merchandising ready to sell. The other one is in the long-term assets, and we have some investments. Okay, that's my assets. Okay, from where, what's happened on the other side now? Going to start talking about the accounting equation, which I'm going to show in the class. Uh, well, on the other side, we have liabilities because of the normal operation of the company, we're generating those expenses, which we haven't paid yet, but we have to pay with the cash that we have in the bank. Okay, that's a liability. And whatever left is going to be for the shareholders. Liquidity. What's liquidity? Liquidity is something very interesting, and that's related to how fast the company can transfer everything that he has into cash. Don't forget, nobody wants income, nobody wants inventory, nobody wants accounts receivable. They want cash. So the question is, how fast we converting everything that we're doing in the company into cash? And then we're going to start working of the liquidity in terms of the working capital. What's the working capital? And that's the current asset minus current liability. Assets are the one that controlled by the company, used to generate sales and revenue. And obviously, the company has control on everything that those assets bring the benefits to the company and control the company. This is the example of assets: cash, short-term investments, accounts receivable, inventory, expenses, and other. Now, liability. What's the liability? Liability is current obligation, which has to be paid in the future because the company did something in the past. Again, liability is current obligation. At today, I owe money to somebody because 2 hours ago he provided the services and I have to pay him 3 hours from now. In other terms, current obligation for something that you did in the past, which has to be paid in the future. That's liability. Examples can be bank loans, accounts payable, deferred revenue not payable, dividend payable, tax payable, long-term debt, anything like that. Then we bring to the question, what's the shareholders' equity? Shareholders' equity simply is a calculation from the assets that you have. Once you pay what you owe for something that you did in the past, how much left? Whatever left, that belongs to the owners of the company, if something left. So for that reason, the shareholders' equity is also called net assets, which net assets again is asset minus liability. And again, remind me, actually, you don't have to remind me, I'm going to show you this accounting equation on the board next time. And we're going to talk about a little bit more. The share capital, it represents the owner's interest in the company. Now, what's the retained earnings? We're going to see retained earnings. There are a few more slides. Just be patient. I want to finish those ones so we can have more time in the class. So the retained earnings will be whatever company earned during the period, plus whatever they have in the beginning, minus the dividend that they paid to the owners of the company. That brings us to the last two statements. One is the statement of the cash flows. Cash statement of cash flows tells you, is this company has ability to generate cash and from where that cash is generated. And we have three options to generate cash. One is from the operations, normal operation of the company. The other one is from the investment activities in the company. And the last one is from the financing activities in the company. The most important cash for the company is the operating cash, because a company that cannot generate operating cash most likely is going to be bankrupt in the next period. Investing activity is how the company manage the cash that it has. Is it working for the sustainability of the company, or just is most likely worry about just to make a quick cash here and there and to disappear? Financing activity is from where the company generate the finances or the funds. Note to financial statements is the last statement, which explained everything about revenue, expenses, assets, liabilities, owner's equity in details in form of the narrative without numbers or supported by the numbers. Now, again, if I have to classify by importance, all five are important. But again, on the statement, income statement, statement of financial position, and statement of the shareholders' equity, you're going to see numbers. When the notes to financial statement, you're going to see explanation of that numbers, from where that number come from, how can I, how that's a calculation of what's included in that number, what else is included in that number, how can I use this number for what kind of type of purposes I can use it, and what kind of analysis I can make. And that's your first chapter, a very light chapter. As you can see, kind of informative chapter for you to understand, grasp some basic idea of financial statements and why do we need the financial statements.